Is the stock market truly random? Can you really beat the market using charts and patterns? Or is it all just a flip of a coin? Let's find out, and by the end of this video, you'll discover if using technical indicators like Golden Crossover and RSI can actually outperform a simple buy and hold strategy. The random walk theory suggests that stock prices move unpredictably, just like the flip of a coin. In other words, past price movements cannot predict future returns. This idea was popularized by Burton G. Malkiel, the author of the famous book A Random Walk Down Wall Street. To prove his point, Malkiel conducted an experiment. He asked his students to simulate a hypothetical stock starting at $50. Each day they flipped a coin. Heads meant the price went up by 0.5 points. Tails meant it dropped by 0.5 points. After compiling this data into charts, Malkiel showed it to a professional chartist. The chartist immediately advised investing in the stock, proving how easy it is to find patterns even when none exist. But not everyone agrees with the random walk theory. Martin Weber, a leader in behavioral finance, found evidence that patterns do exist. For example, he discovered that stocks which performed exceptionally well over 5 years often underperformed in the next 5 years. He also found that stocks with upward earnings revisions consistently outperformed others over the following 6 months. This suggests that the market is not entirely random. There are patterns investors can exploit. To put these theories to the test, let's analyze the performance of the Nifty 50 index. Over the last 20 years, from January 2005 to January 2025, a simple buy and hold strategy yielded a compound annual growth rate of 12.85%. If you made systematic investments known as SIP during this period, your compound annual growth rate would be 9.34%. But what if you tried to time the market using technical indicators? Using the Golden Cross strategy, where the 50-day moving average crosses above the 200-day moving average, you'd get a compound annual growth rate of 11.98% before brokerage and 11.96% after brokerage. However, using the relative strength index strategy yielded a disappointing compound annual growth rate of just 3.61% before brokerage. So what can we learn from this? While technical analysis can provide useful signals, the evidence suggests that beating a simple buy and hold strategy is difficult and sometimes impossible over the long run.